What's up, everybody? I'm Zuhair. Most people are breathing a sigh of relief today because they think the financial dragon has finally been slain. Taking a look at the latest from ABC News, inflation has officially dropped to its lowest level in months, defying expectations that prices would keep soaring. They're reporting that prices only climbed 2.7% in November. The mainstream media wants you to believe the war is over and it is safe to start spending again. But here at Seed to Growth, we see the hidden trap that the crowd is walking straight into. While the uninformed are out celebrating, savvy investors are silently moving their wealth into assets that actually grow. If you do not understand the wealth building map hidden in this headline, you are going to stay broke while the elite get richer. Before we expose the Fed's secret playbook, smash that like button. It helps the YouTube algorithm find more people who want to stop being consumers and start being investors. Let's start planting real growth by looking at why these numbers are not what they seem. Observing the report from CNBC, while consumer prices rose at a 2.7% annual rate, the real kicker is that this data was delayed. This is modular education for your wallet. When the system uses delayed data, you are making financial decisions based on a past that is already gone while the current pain is hitting your soil. The crowd hears 2.7% and thinks prices are falling, but savvy investors see the guacamole trap. Think about Chipotle. Last year, that scoop of guacamole was $2. Now it is 2.5. If inflation drops to 2.7%, that guacamole does not go back to $2. It just means next year it goes to 2.56 instead of $3. You are still paying more. The masses celebrate the slower increase, while their seeds of wealth are being eaten by pests. You do not want to celebrate a slower death for your dollar. You want to own the farm that produces the guacamole. But it is not just about one lunch. It is about the entire mountain of debt that has been building up over the last few years, which we can see on the next chart. Notice on this U.S. Consumer Price Index chart, we are staring at a massive mountain peak from 2022 where inflation hit 9%. The uninformed look at the current tail end where the line drops toward 2.6% and 2.7% and think we are back to normal. But that is the diet money lie. Think of your weight. If you gained 50 pounds in 2022 and then only gained 5 pounds in 2025, are you skinny? No. You are still 55 pounds heavier than when you started. The price index is not dropping. The speed of the rise is just slowing. The average person sees the downward slope and thinks things are getting cheaper. Wealth builders realize the cost of living has permanently reset to a higher level. Your $150 jacket now costs $210, and it is never going back to the old price. Do not be fooled by the slope. Look at the price and plant your growth accordingly. This permanent price hike is exactly why the Federal Reserve is now panicking and trying to change their strategy before the economy stalls out completely. Check out this update from NPR, where a divided Federal Reserve has just cut interest rates for a third straight time as of December 10th, 2025. This is where lifestyle math gets dangerous. When the Fed is divided, it means the 1% is arguing about how much more sugar to pump into the system to keep it from collapsing. The crowd sees a rate cut and thinks it is time for a new truck because the monthly payment just dropped. Informed investors see a rate cut as an emergency oxygen tank for an economy that cannot breathe on its own. If they have to cut 3 times in a row, they are trying to prevent a heart attack in the banking system. The masses take that oxygen to go to a party. Wealth builders prepare for the inevitable volatility. When money gets cheaper for the banks, the value of the dollars in your pocket is being diluted. Use this window to buy assets, not debt. This interest rate move is only half the story, because while they lower rates, they are also quietly starting. The printing press is back up. Per the coverage in the Wall Street Journal, the Fed is resuming net asset purchases with $40 billion in securities this month. To a beginner, this sounds like boring accounting, but in the seed to growth world, this is the invisible printing press. The crowd has no idea this is happening, but by buying $40 billion in securities, they are literally injecting cash into the system to fix repo market strains. This is the IRS game at the highest level. They are not printing physical bills. They are adding digits to bank balance sheets. The masses wonder why house prices keep going up while they are priced out. It is because $40 $40 billion of new money is chasing the same number of houses. The elite get the new money first and buy the chairs before the music stops. Get your seeds in the ground before the hose stops. This flood of new cash is creating a temporary high in the markets, which has everyone feeling like they are finally winning, even though the foundation is cracking. Evidence from Market Minute indicates this dovish pivot is fueling massive optimism and igniting the markets with fresh liquidity. In Fed speak, dovish means they are going to keep the money flowing. The crowd sees this and gets a major case of FOMO, dumping their savings into whatever is trending. This is the sugar rush analogy. You eat the candy, you feel amazing for 20 minutes, and then you crash. Savvy investors understand that this optimism is built on Fed debt, not real economic growth. The 1% uses this fuel to sell their overvalued stocks to the 99% who are just now arriving at the party. We do not buy based on optimism. We buy based on cash flow and value. If the market is igniting because of liquidity injections rather than real profits, that fire can go out the moment the pump stops. We do not chase the flame. We own the land the fire is burning on. This market euphoria is also being used as a political shield, with leaders pointing fingers at each other for the high prices you still pay. As stated by Reuters, Fed Chair Powell is claiming that the recent inflation overshoot was caused by Trump tariffs. This is the blame game modular education. The crowd gets sucked into the political fight, arguing on social media about who is right. Wealth builders ignore the noise and look at the math. Whether it is tariffs, printing, or supply chains, the result is the same. Your money buys less. This is the $150 jacket trap. If a tariff adds $20 to the cost of a jacket, the store does not pay it. You do. The masses wait for a politician to fix the economy, but informed investors realize the system's goal is to keep you consuming. Powell blaming tariffs is just a way to distract you from the $40 billion they are printing every month. Do not let the theater stop you from planting. Savvy people only care about the green team, the team that owns assets. While politicians argue, the actual experts are admitting they have no idea what is actually going to happen with the economy next. According to a piece from MarketWatch, two Fed officials who rarely agree both now say inflation will not be a problem going forward. When the hawks and doves agree, the crowd falls into a false sense of security. But savvy investors know this is the boiling frog moment. They are telling you the water is fine while they keep turning up the heat. Remember, these are the same officials who said inflation was transitory in 2021. The masses trust the experts. Wealth builders trust the numbers. If they are struggling to find a policy that balances inflation with worries over a sluggish labor market, it means the soft landing they promised is actually a very bumpy ride. The informed do not need the Fed's permission to be cautious. We stay liquid and we stay prepared while the crowd sleeps. When everyone agrees there is no problem, that is usually when the biggest problems are hiding. They are so unsure of the data that the market is now betting on the Fed simply sitting still for a while. Scanning the data from the CME FedWatch tool, there is a 75.6% chance that the Fed will keep rates exactly where they are for the January 28th, 2026 meeting. This is the pause trap. The crowd sees a pause and thinks the work is done, but wealth builders look at the lifestyle math of a 350, 375 target rate. If rates stay here, the cost of debt is still much higher than it was for the last decade. This is the 0% down payment lie resetting. Millions of people bought things they could not afford when rates were zero. Now that the Fed is pausing at a higher level, those people are realizing they cannot refinance their debt. The masses wait for the Fed to save them with more cuts, but a pause at over 3.5% is still a weight on your neck. Savvy investors do not bet on what the Fed might do. We bet on our ability to generate income that outpaces their debt. If you want to know where rates are really headed, you have to look at their long-term roadmap. By examining the summary of economic projections, the Fed expects the federal funds rate to drop gradually to 3.4% in 2026 and 3.1% in 2027. For a beginner, this looks like a guarantee of lower costs, but look closer at the longer run projection of 3.0%. Savvy investors realize the new normal is 3 times higher than the zero-rate environment we had for years. The crowd thinks they will just wait until 2027 to buy a house, waiting for a bargain that will never come. But as rates drop, The elite will use their massive piles of cash to bid up the price of those houses even faster. This is the IRS game again. Lower rates make the elite richer because they own the assets. The masses just get a slightly lower monthly payment on a much more expensive home. This roadmap is not a guide for your wealth. It is a guide for their stability. They need a specific type of leader to execute this roadmap, which is why the fight for the Fed chair is so intense. A report from Reuters notes the next Fed chair will likely be someone who believes in lower interest rates by a lot. This is the sugar addict narrative. The political system is now demanding the Fed print more and cut faster. The masses hear lower rates and think free money, but savvy investors understand that lower rates by a lot is the fastest way to kill the value of your dollar. It is like a coffee shop that keeps adding more water to the pot. Eventually, it does not even taste like coffee anymore. The elite love lower rates because it inflates their stocks and real estate, while the crowd struggles as groceries and rent become more expensive. The masses think the next Fed chair will be their hero, but their real job is just to keep the debt bubble from popping. No matter who is in that chair, the math stays the same. And right now, the candidates are already making massive promises to secure their spot at the table. The Financial Times highlights that Fed Governor Christopher Waller is claiming that interest rates could be cut by as much as a full point. This is Waller's audition for the Fed chair role as he prepares to meet with Donald Trump for an interview. For a beginner, a 1% cut sounds like a gift, but in lifestyle math, a 1% cut is a massive emergency signal. The Fed does not cut by a full point unless they see something breaking in the background. The crowd sees a full point cut and goes to the mall. But wealth builders ask, what is so broken that they need to move that fast? It is the emergency room analogy. You do not get a shot of adrenaline unless your heart has stopped. If Waller is promising a full point, the soft landing might actually be a crash landing. Savvy investors are already moving to the exits while they tell you how great the cut will be. This power struggle is creating a civil war within the government itself. As reported by Politico, Trump officials are privately raising doubts about Kevin Hassett for the Fed chair position. This is the internal Civil War modular education. Even the elite cannot agree on who should run the show. The masses get confused by the drama, thinking it matters which Kevin gets the job. But savvy investors know the seat is more powerful than the person sitting in it. Critics say Hassett has not been effective as head of the National Economic Council. In the seed to growth world, that means he might not be dovish enough for the new administration's goals. If there is conflict in the leadership, there will be conflict in the currency. Informed people do not bet on the person. We bet on the pattern. The pattern is always more debt, more printing, and more inflation. Protect your capital now. While the government fights over their top pick, the market is already placing bets on a dark horse candidate. A headline in MarketWatch mentions Kevin Warsh is newly ascendant in the race for Fed chair, though some analysts believe his chances could be overblown. Here is the market speculation clue. The system loves to float names to see how the 1% reacts. The crowd hears a name and tries to predict the future, but this is the betting on the jockey trap. You can have the best jockey in the world, but if the horse is old and tired, you are not going to win. The horse is our debt-based economy. Warsh is seen as more hawkish, which the elite hate because it could slow down the sugar high. A Warsh appointment might mean a temporary stock market crash as the free money is taken away. Wealth builders do not fear a crash. We prepare for it. A crash is just a fire sale for the savvy who have cash. But for now, the path of least resistance still points back to the original frontrunner. Looking at the week, Kevin Hassett appears to be Trump's pick for the next Fed chair. This is the final clue in the leadership drama. Hassett is seen as the frontrunner despite the doubts mentioned earlier. For the seed to growth community, this confirms the dovish path. Hassett is expected to do exactly what the political system wants: lower rates and keep the party going. The crowd sees this as stability, but wealth builders see it as continued currency devaluation. This is the guacamole trap lesson one last time. If the new Fed chair is picked specifically to keep rates low, your groceries are going to keep getting more expensive. Savvy investors are happy because their asset prices stay inflated while the masses struggle to pay rent. The system has chosen a path of more sugar. Our job is to own the sugar factory. The scary part is that they are doing all of this based on numbers that might not even be accurate. Information from Yahoo Finance shows economists are warning that it is hard to take this data seriously because a government shutdown impacted CPI data collection. This is the most dangerous clue of all. The crowd is making life-altering decisions based on numbers that the experts themselves do not trust. It is the blind pilot analogy. The pilot says the fuel gauge is broken, but he is going to keep flying anyway. The masses hear 2.7% inflation and think it is a fact. Savvy investors realize it is an estimate based on incomplete data. We do not rely on the government's broken gauges. We look at the real world. Are your bills higher? Then inflation is not cooling for you. The elite know the data is fake, so they hedge with gold, real estate, and Bitcoin. Do not be the person who trusts a broken fuel gauge. Your safety depends on you ignoring the headlines and looking at the ground beneath your feet. Look, I know this feels like a lot. You are seeing headlines about broken data and emergency cuts, and it feels like the game is rigged against your growth. It is okay to feel stressed. The masses feel that same pressure at the grocery store every single day. But here's the map out of the stress. Stop focusing on the 2.7% and start focusing on your own economy. The big picture is that the system will always prioritize the elite and their assets. Your job is to stop being a consumer and start being an owner. The actionable step is simple. Invest first, spend later. Focus on your cash flow. If you can grow your income through assets, the Fed's delayed data cannot touch you. Plant your seeds today so you can eat the fruit tomorrow. Keep thinking like the minority. Smash that like button if you want to protect your wealth. Share this video with a friend who is still trusting the mainstream media, and comment growth below to join the community.